You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. I should let you know that we are taping Options Playbook Radio on Wednesday, January 20th. It is the day of the inauguration for Joseph R. Biden. The markets were rocking and rolling today. The VIX has finally came down a little bit, but it's still staying above that 20 level stubbornly. It really hasn't breached that since the pandemic. We've touched it a couple of times, but we've never been able to breach that in the VIX index. And we had a big update, still have the VIX above 20. So here's what we're going to look at doing today, and we're going to just jump right into the trade. And I haven't really looked at, as always on Options Playbook Radio, we're just trying to look where strategies may fit with the underlying pricing mechanisms of the options marketplace. It's never meant to be a recommendation. We try to go through as many of the plays inside the Options Playbook as possible. There are over 40 different plays that are talked about inside the Options Playbook. And for the first time, I'm going to look at a butterfly, not as a directional play, not as a skip strike butterfly trying to get it done for a net credit. We're just going to look at a butterfly. And one of the reasons why is that we have the volatility index up. We have the markets up. We're really kind of looking at a volatility play. When you think implied volatilities are coming in, there are a couple of trades that you can do. You can go on out in the marketplace. You can find an underlying. You can sell some put spreads, sell some call spreads, maybe sell an iron condor. But not all the time do a lot of people think of a long butterfly as a trade that you want implied volatilities to come in at. Now, the market is leaning bullish. There's a lot of indicators in the marketplace that have hinted to the fact that the path of least resistance is to the upside. We still obviously have a lot of potential news out there that can happen. We still have a pandemic going on. We're still trying to get everybody vaccinated. That is going slowly, but it is happening. We still have a lot of things that are just going on as far as unemployment, as far as the economy. So with that said, we're going to take a little bit of a shot at volatility. Now, what's one way that you could do it? And we have talked about these trades inside Options Playbook Radio. We talked about a couple of VIX back spreads that we were looking at. One of them in particular was right before the election. Implied volatilities ran up, and we did a back spread that actually turned out pretty well when it was all said and done. guessing that the VIX index was going to go down after the major event, which was called the election. Now we had the inauguration. We're going to approach it a different way. We could do a back spread using VIX options going out a couple weeks in time, but we're going to try to learn something new here, and we're going to do a trade not necessarily on the forecast of the underlying marketplace, but more so, maybe let's see if we can get that VIX below that 20 level. Let's just kind of hope that maybe that'll happen. Now, it's getting to the point where basically 20 is the new 15 in the VIX because it's been so long that we've been above that level that if you look at moving averages, the moving averages on a 200-day basis or so are hanging right around that 20% implied volatility level for the S&P 500 index. But that's what we're going to do today. Not meant to be a recommendation, but I think it'll be a fun trade to look at. Come back in a couple weeks' time and see if we can figure out the range of the marketplace, because that's one thing we're going to have to look at. And then hopefully get a little bit of a downturn in implied volatility and have this butterfly work out for us. So we're hoping to get a little bit of time decay. That always helps with the butterfly. And we're hoping that we get a decrease in implied volatility. So what better instrument to use when you're looking at the VIX and trying to forecast a downturn in volatility than the underlying that the VIX is based off of, which is the SPX, the S&P 500 index. We're going to go out to the January expiration. Now, I've mentioned that the market has been bullish, set an all-time high here recently once again. A lot of the indexes are bullish, including the Russell 2000 index, which is actually leading the way in 2021 to the upside. So we're going to skew a little bit to the upside, but that's just because we might as well pick some direction, right? But we're not going to go way out of the money. So because we're going to go a little bit to the upside, we're going to use call options. If we were going to go a little bit to the downside, we'd use put options. And obviously, if you're doing this on paper, you can decide which way you'd like to lean. We have the S&P 500 index closing today at 3851.85. It was up $52.94 on the day. So we're going to buy an option contract that's a little bit in the money, sell a couple option contracts that are a little bit out of the money, and then buy some more option contracts that are further out of the money. And we're going to use the January 29th expiration. As I mentioned, today is the 20th, so we will have 9 days until that expiration date. It's one of the weekly option contracts, so it will stop trading on the close on the 29th. And you always got to be careful when you're in the SPX because they do have American style and European style option contracts that are mixed in. The normal, and I use that with quotation marks, especially in this day and age, but the normal marketplace, the third Friday of the month, those option contracts actually stop trading on the Thursday because those are considered American style options. Now, I did actually have I had words with the Chicago Board Option Exchange when I was on the retail market committee, asking them to basically just go and make two chains, make an SPX chain, and I preferred that you would make an SPX AM and an SPX PM chain. And if anything, just make that chain available. I don't want to get, if I've been trading these things for a good bulk of my career, if I know I want to trade PM, I just want to pull up the PM chain and just look at PM option contracts. And those are option contracts that expire after the close, for example, on the 29th, after that day's trading, as opposed to the day before, which would be the 28th. And those are AM option contracts. So if you're trading the SPX, it is by far the most confusing index to get quotes on. All right. So a lot of platforms have kind of addressed that. But one thing that is a dead giveaway to let you know it is a PM settled is that if you do pull up a quote, if you do look at not necessarily a chain, but actually look at a quote of the option contract, the basis of the symbol actually has a W in it, SPXW, and those are PM settled option contracts. So that's a little bit of a secret. Okay, so we're looking at SPXW option contracts, and we're going out to January 29th. Here's the butterfly we're going to look at. We're going to be buying the January 29th 38.30 call option, and then we're going to go 30 points up, and we're going to sell two of that same expiration, 38.60 call options, and then we're going to go out and buy one of that same expiration, 38.90 call options. All right, so if we do the math here, it's a 30-point wide butterfly. The net debit at the midpoint is $4.85. That means for every 1 by 2 by 1 butterfly, we're going to pay $4.85 at a net price, and that would be $485 minus commissions. Now, the markets are closed, and I'm going to make the math simple on us, partly because this is a radio show, and it's kind of hard to show a graphic when you're just speaking. But overall, we'll say it as a $5. Let's say if we could execute this at $5, that would be our max risk. It would cost us $500 to put the trade on, plus commissions. I always got to think about that. But then that makes the math easy. So here's the numbers that I really care about. This is a shorter term trade. It's going to go out of 9 days until that expiration date. And if we're doing this, every day that goes by is going to be a big time decay day. And hopefully, if the markets continue up a little bit, we get a decrease in implied volatility too. And that will help out. Now, specifically, if we can get to 3 or 4 days remaining to the expiration date, that's where you see a huge decay in SPX options. And why is that? Well, options are based off of the valuation of that underlying. So, for example, if you actually think of options as what they were first intended to be insurance products, and you think that figures into their pricing, it kind of makes sense that it's going to cost you more if you were buying car insurance to insure a more expensive car. So it's going to cost you more to insure a Bentley than it is a Chevy Cavalier, right? It's because the sheer cost of the underlying. So if we have a $3,850 index, that's going to cost you more than insuring a stock like Walmart, which is $140 some odd stock, right? The cost of the underlying, the value of the underlying makes these options real pricey. And now we're in volatile times too, so that actually adds some premium. So for example, the option contract that we're selling, the 38.60 option contract, is a $31 option contract. By that expiration date, I don't care if that option contract is out of the money. I don't care what that underlying is. It has to go away. Time decay has to happen. So SPX option contracts seem to hold their value a little bit longer than if you're looking at a just normal underlying, like let's use Walmart again as an example. Okay. So 9 days, you could even go out a little shorter if you want to, but it's going to be a little bit costly if you do this. We got $5 on here. If we pay $5 for it or $500 for this butterfly, that means that our break evens and where we want this underlying to stay within would be the strikes that we bought plus the premium and minus the premium. So for example, we're buying the 38.30 strike call. That's our in-the-money call. Add $5 to that. That break even at expiration would be 38.35. And the further out of the money option contract that we're buying is a 38.90. You would subtract $5 for that, and that'd be 38.85. And those would be our break evens. So we're looking at about a 50-point range that we would like this underlying to stay within if we do this trade. If we don't think it can stay within that range, well, then we don't want to do the trade. Bottom line is you are not doing this trade if you don't think it can stay within that range, at least for the next, let's say the remainder of the week. If we make it till Monday, we're doing pretty good. Anywhere within that range, you're probably going to do okay. But the ideal spot that it would land would be the 38.60 strike. Okay. Our upside, if it did land at 38.60, would be $25. It's a 30-point wide spread minus the premium paid of $5. So we got a lot of upside relative to the risk to the downside. But if you look at this, obviously getting the maximum on this trade is not the goal, because that means it would go right to our short strike and just hang there and stop there right at the expiration date. So if you're doing this trade, it's not a trade that you're looking to make a home run on. You're going to pay $5 for it. The way that I would approach it is, on the upside, I want to make a little bit more. So let's say our goal is to make $3 on the trade on the upside. We would like the underlying market to kind of hang where it's at. If it drifted a little bit north, that would be good. But mainly, we want time to decay. We want implied volatilities to come in, and we want expiration to come to fruition. So in this instance, if I put this trade on for $5, then I could get out for $8 or even $9. I'm going to do it. But if it starts going against me and it goes below any of my long strikes, I'm definitely going to get out for sure if it goes above or below my long strikes that I bought. But if I just want to concentrate on price, I would say to myself, well, I'm paying $5 for this trade. If I lose half of it, I'm going to get out. If I see this thing trading for around $2.50, I'm going to get out of that trade. Now, it's going to be a very weird thing. This is actually going to be a real fun to watch trade or strategy if you've never traded in the SPX or a very pricey index, because each day that goes by, there's going to be so much time to gain, especially if we can make it through the weekend and get to Monday of next week. Then you'll see a very large rate of decay. So this is a great one to watch on paper and just see how butterflies are priced in very expensive indexes. So let's recap. What's our forecast? Our forecast is a neutral marketplace. We think that the market could go up a little bit. We leaned a little bit to the upside, but our main goal here is to try to take advantage of time decay and hopefully get a decrease in implied volatility. So we're going to go out 9 days. We're going to go to the January 29th expiration. These option contracts will stop trading on after the close on Friday, January 29th. We are going to buy the SPX 3830 strike call, sell 2 of the SPX 3860 strike calls, and buy 1 of the 3890 strike calls. We're going to get this done. Right now, the marketplace is saying it's $4.85 on the net debit. We'll call it $5, make the math simple. That's our goal, that we could fill it somewhere around $5. That means our total risk would be $500 plus commission to put on the trade. Best case scenario on the upside would be you could sell it for $25. But if you did that, you should actually receive the stupid award, because you should have been out a lot sooner and not hung around and kept all that risk. All right. That's going to be it for this episode of Options Playbook Radio. If you have a question you'd like us to discuss on the show, you can email them directly to me at theoptionsguy@invest.ally.com. Please check out optionsplaybook.com and start following me on Twitter. My handle is simple. It's Brian Overby. So feel free to send me any questions that you may have. And until the next time, may all the options you bought finish in the money and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's MIXLR.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.